For over 100 years, the way we've made sure our banks are safe has really been based on a highly educated guess. Regulators would look at a tiny, tiny fraction of a bank's business and just assume it represented the whole picture. But that whole era of guesswork, it's about to come to a very, very abrupt end. So, at the very heart of this huge change is a shift from what we'll call assumption auditing to transaction auditing. And really, it's the difference between trying to guess what's in a giant warehouse by peeking through the keyhole versus just opening the garage door and seeing absolutely everything inside. One is a guess, the other is the ground truth. To really get a handle on where we're going, we first have to understand where we've been. For the better part of a century, financial regulation has been running on this exact system of assumption auditing. Now, the way this worked is kind of wild when you think about it. An examiner from a regulator would literally walk into a bank and say, hey, show me a sample of, say, 50 loans. And if that tiny sample looked all right, they'd basically give a thumbs up on the health of the entire portfolio, which, by the way, could have millions of loans in it. I mean, just look at this chart. It really puts into perspective how massive that assumption was. The sample size is that little sliver right there, compared to the mountain of total transactions. We have essentially been regulating the entire global financial system based on what is basically a statistical rounding error. And for a long time, this system of educated guesswork, it kind of worked more or less. But in today's high-speed, high-volume world of finance, those little cracks in the system have turned into massive, catastrophic failures. It turns out the sample can easily miss the rot that's hiding just out of sight. And of course, the most obvious recent example was Silicon Valley Bank, right? Its collapse was just shockingly fast. And it's precisely because the huge systemic risk it was taking on wasn't visible in a typical small-scale sample. It was just a brutal lesson that today a problem can grow to a fatal size long before the old-school methods even have a chance of spotting it. But here's the interesting part. In the background, regulators have been quietly building the solution. And this isn't just some small tweak. It is a total paradigm shift. It's called the SupTech revolution. And the new machine they're building is, well, it's very, very hungry for data. SupTech. It stands for Supervisory Technology. And it's the engine that's making all of this possible. Its goal is actually simple but incredibly profound: to ingest and analyze everything. Not a sample, not a summary report, but the raw, granular, real-time data flowing straight from the banks themselves. So here's the bottom line. The clipboard is on a deadline. The theory, and it's backed by a ton of evidence, is that by 2029, the entire concept of a human auditor walking in and asking for a manual sample will be a thing of the past. It's all going to be replaced by a direct automated data pipeline. Okay, I know what you might be thinking. This sounds a little bit like science fiction, but it's not just some wild theory. If you know where to look, you can see that regulators have been laying the groundwork for this for almost a decade. So let's follow the breadcrumbs. It all starts with a really simple question. Why on earth would a regulator, like the OCC in the US, need to build a massive petabyte-scale data warehouse if their main job was just to read summary reports and PDF files? The answer is they wouldn't. Unless, of course, they were planning to store something much, much bigger. And this timeline here, this is where it all clicks into place. See, back in 2013, a regulation called BCBS 239 basically forced all the big banks to get their risk data in order. In doing so, they essentially built the pipes. Then, around 2018, the OCC started building its own data vault. That's the warehouse to store all that data. So the pipes are built, the warehouse is ready, 2029 is just the year they plan to turn on the faucet. So, what does this new world actually look like? This is not just a faster version of the old way of doing things. No, this is a completely different reality. Let's call it the age of transaction auditing. So here's the fundamental change. The bank examiner, that person who used to fly out to visit your office, they don't need to get on a plane anymore. They don't even need to pick up the phone. Their algorithm will just reach directly into the bank's live database and start asking its own questions. And those questions are going to be incredibly specific. Instead of asking for a general report on loan quality, the query will be something like this. Show me every single loan originated on a Tuesday anywhere in the country to a borrower with a credit score below 600, and it will get the answer instantly. Or think about it from a risk and compliance angle. The algorithm could ask, Show me a list of every single wire transfer across all divisions over $10,000 that has any connection to a known crypto exchange address. The system is going to see patterns that a human team could never, ever spot. And it's not just about finding the big, bad fraud. It's about data quality. An algorithm can be as simple and as ruthless as this. Show me every single customer record in the entire mortgage portfolio that is missing a zip code. There is literally no place to hide messy data anymore. And this brings us to the final, and maybe the most crucial point for anyone who works in this industry. There is a massive trap here, and a lot of institutions are walking right into it. You could, right now, be failing an audit that won't even officially happen for another 5 years. The path to failure is actually pretty simple. Step 1, you just ignore the shift. You think it's something way off in the future. Step 2, you assume your data quality problems are something you can just clean up later. Step 3, you wait. And then, step 4, you fail the very first query from the regulator's algorithm. It's an instant fail. Game over. Because you have to understand, this new kind of auditing, it is absolutely ruthless. It has perfect memory. An algorithm doesn't care about excuses or explanations. It will find every null value, every missing field, every little dummy entry a developer patched into the system 5 years ago to fix a bug. Your entire database history is now totally fair game. The key takeaway, the thing to remember, is probably best summarized by this really powerful metaphor. The vacuum is coming. And it's not just coming for the bad loans or the suspicious transactions. It's coming for everything. If your data isn't perfectly clean, perfectly tagged, and ready to go, you're going to get sucked up right along with it. So the real question isn't if this is going to happen, but are you ready for when it does?